All right. Good morning, everybody. It is October 3rd, 2023, 8:45 a.m. Another beautiful day to be on planet Earth, October 3rd. What is today? Today's a Wednesday? No, today's a Tuesday. We just said Monday yesterday. Today is a Tuesday, and we've got a lot to talk about. The biggest headline of the day is the 10-year Treasury yield has got to the highest level it has gotten in 16 years. I do not think that it is sustainable to have the 10-year be high for that long. I definitely think the Fed is going to think twice about raising interest rates now that the 10-year has gotten to that level. If the 10-year somehow inks its way up to 5% right now, hitting at 4.7, if you saw the thumbnail, it's going to be really tough. And we are likely to see some pain today. If I had to guess if stocks were to go up or down today, I would guess that they're going down because the 10-year giving you this much of a yield, you're likely going to see some pain in equities because money's going to flow out of equities and go into those bonds. We're seeing a lot of things down in the pre-market. PayPal's down, SoFi's down 1%, Palantir's down 1.3%, Netflix is down, Nvidia's down 0.21%. So we're seeing a lot of pain in the markets. We'll see if this 10-year drops as the market opens or it continues to get momentum. That's going to determine pretty much the rest of today. And second of all, the SBF trial is starting today. Sam Bankman-Fried is officially going to trial. They are doing jury selection today, so we have some updates on that and what's going to end up happening with that trial. I got a little bit of coverage of it last night and just how his mindset worked and how he ended up building his fortune and kind of what's going on with his overall process to like understand how FTX is collapsing and what the ramifications are. There's a lot of interesting stuff, including some of the money he was going to give to different presidential candidates. There's a lot to talk about. So we'll get some updates on what's going on with SBF, and we'll keep going from there. Marcus, Sasky Rose, Charles, Tessa Best, Sethi Roth, Bay Ray, David, Missy Iger, Ty Gordon, Imnop, Roy, Marvin, Harry, Hakoon, Jose, Raul, Midwest, Invisible Voices, Jabak Music, Quarantine, Quartet, Jeremy, Black, Colin, Art of War, Blake Anderson. Thank you all for being here today. Good morning from Ohio. I've never been to Ohio. I've been to some parts of the Midwest, but never Ohio. I gotta go to Ohio one day. Thank you all for being here. Erwin, WB, W Bagoon, thank you, man, for being here. Sachin, Greg, thank you all. All right. So I think we'll get started with well, you know what we should get started with? We should get started on a lighter note before we get into the deep sadness that is this 10-year yield. And the lighter note is going to be something that Bay Ray tweeted yesterday. I think it is important that everyone sees this because it's a much lighter note. But we have to, start with this versus starting with something else. So this is Jim Cramer's updated thoughts on Palantir.
And curious about all the hype in the AI industry and your take on Palantir over the next few months for the end of the year.
Okay, so Palantir actually has real business. I was a little skeptical about those fellas. That's the second time I've honored Will Frost. Renaissance was the other, I think. But I got to tell you, here's the way I feel about Palantir. They had a really good quarter, and they actually lived up to their hype. So I am reluctant to say anything bad about them, and they're going to make money. So I say Palantir, 2 cheers for Palantir. Let's go.
And curious.
So my thoughts on this were that it was a fun ride while it lasted. It was a really fun ride while it lasted. They had a good time, made a lot of videos, got a lot of memories, a lot of friends. As you can see, Palantir is down $15.66 in the pre-market. Just like it's just on time, whatever Jim Cramer had to say, it was absolutely on time for what we're dealing with now. He said this about SoFi a couple of weeks ago, by the way. He said SoFi's a buy, and then SoFi was like, whoop, we're not going to $8 anymore. We're going to stay stuck at the $7.75 range. So if he is a, indicator of anything, I'll see you guys on the other side of below 14 on Palantir. And I'll be buying below 14. But we will, we will probably get our opportunity once again on Palantir. So that's the light note to start off the show. All right, let's move on to the 10-year. So the 10-year, this is kind of the breaking news this morning, getting to their highest levels that they have been at really in the past 16 years. It's pretty insane kind of seeing it get to this level. Why is that? Why is it at 4.7%? Essentially, there's a variety of reasons, but the number one reason is the market does not believe that equities are a better place to bet than U.S. bonds. We talked about this a little bit last night on Finance Junkies in terms of what the point of a 10-year is, what the point of these bond yields are. And you will be making 4.727% on your money if you invest in a 10-year treasury, which is relatively no risk compared to putting your money into equities. Now, the reason this is significant today is because this is the highest level it's been at in 16 years. And in 16 years, I mean, like, think about that. In 16 years, we have not seen the 10-year get to this level. And one of the things that was interesting a couple of days ago, as I was reading some analysis, is that we were having and sustaining 4.2 to 4.4 yields on the 10-year from 2000 to 2006. And it was reasonable. The economy still did well. Stocks did well. Everything was fine. The great financial crisis happened, and then 10 years spiked to like 4.8, 4.9. And so that was unsustainable with equities because you can't have a 10-year giving you almost 5%, right? Because then there's no liquidity to go into equities. But we were able to sustain a little bit lower than this in order to have a decent economy. So one could argue that we can still have a 4.0 to 4.4 10-year yield, and it doesn't ruin the economy. There's still enough equities. There's still enough liquidity to flow into equities and enough money to give to 10-year. And it's probably a better balance because if you have less money going into equities and more money going into 10 years, if it's at a 4.4, 4.2, then you have less of a chance of inflation coming back. And if inflation dies down naturally, some of that money is going to leave the 10-year naturally and go to the equity markets. So it's not unsustainable to have 4% as a 10-year treasury yield. We've had that for a long time. The economy was fine. The problem is when you get close to 5, now you're getting into a territory that's not really fun. And when you get into a territory that's not really fun, you have a much harder time to be able to deal with some of the ramifications of, having the 10-year be that high. The question here today is going to be from an algorithmic trading perspective and also from an institutional perspective. Do equities dump on this news? Equities already down. That makes sense. S&P 500 right now, we are not at the 200-day moving average, but we are close. S&P in the pre-markets, 424. So $4 away from that 200-day moving average. We haven't hit the 200-day moving average in September. Remember, we just got close. We got to 422.5, but we didn't get to 420. That 420 is an official 10% correction, which, I mean, I think it's reasonable to expect we get that, especially on a day like this. But if that happens, that may be the day where we finally rip off the Band-Aid. I think we've been waiting to rip off the Band-Aid for a long time. If we can't sustain 420, then we break down lower, and maybe 410, 405 is the next area of support. It just becomes kind of ridiculous if you get to those levels, right? That's when potentially all the trillions of dollars that are in money market funds and in equities or in yields and bond yields would decide that the yield on their bonds and their money market funds just aren't worth it, and they would rather buy the S&P at 420 or 405 or 415, whatever it may be. So that's going to be the most interesting thing to see in this market, is where does the market decide to take equities in the face of these 10-year yields that are not slowing down. They have, like, it was an all-time high since 2007, then an all-time high after that. Like, it just kept going up the past couple of days. It really hasn't showed any signs of momentum going on the downside, especially when equities were going up to the 430s on the S&P, rebounding from the 422. So everyone thought, oh, well, we were oversold. That's why we're getting bought on the last day of trading in September. Doesn't seem like that's the case right now. It seems like equities are going to have to continue to capitulate to find their bottom. Enovix, someone's asking in the chat, is down 10%. I don't own this stock, but it is at $10.59. Enovix at one point, I think, was at $21 this year. And most people, I believe, that had the stock were not holding on to it. I mean, a lot of people they made like $40,000 in revenue last quarter. So it was a lot of speculation, even though there's a lot of potential in the company. Right now, down 10%. I don't know what happened to it. Probably some piece of news came out that's not the best, and it's down 10%. Enovix is a very long hold, so if you're buying this company, I wouldn't be too concerned about the up and down swings. It's kind of one of those end phase companies that you buy and you just let the story play out and see if it happens. But Enovix right now is down 10.58%. Okay, so that's what we got on the 10-year yield. It's going to be a really interesting day to see if the market continues to go higher, or if they say, screw the 10-year, we're just going to keep doing what we need to do, or if we end up selling off because of it. Having said that, we also have another piece of news that's really interesting, and let's go to this. Microsoft, a couple of months ago, said that they were launching their official Copilot subscription. Now, this was a pretty big piece of news. Copilot is their $30 a month additional subscription powered by AI. So Excel, PowerPoint, all this stuff is powered by AI. Microsoft has about 430 million users, and the street estimated if 10% of people upgrade to this $30 subscription, that's going to bring in something like $16 to $20 billion top line revenue, and that would add another $80 billion if you put a 4x multiple on that in market cap. And that's when Microsoft went up to like $380 back at the hype of June and July. Obviously, it's come down significantly since then, still in the 320 ranges, I think. But yeah, that AI hype is 321. That AI hype did not lead to anything real because there were no profits, right? There was no real increased revenue. That is launching today. And so it's launching November 1st. So let's get an update on what they plan to do, how they plan to roll this out. And if this ends up working, there's probably going to be some serious numbers that Microsoft's going to see going into 2024.
Microsoft is going to begin selling its new AI tool called Copilot for $30 a month starting in November. But the question is, will this product live up to the AI hype? Steve Kovac joins us right now with more. Steve, what do you think?
Yeah, well, Becky, all year, everyone's asking, can anyone besides NVIDIA generate meaning sales directly from AI? Well, Microsoft is about to try a month or so from now with the launch of its new AI assistant, Copilot, for business customers. Like you said, costs $30 per user per month, nearly double what companies are already paying for a Microsoft 365 subscription. That includes apps like Teams, Outlook, and Word. Question investors have been asking, though, is it worth that steep price? Microsoft has already had some customers testing an early version of Copilot ahead of the launch. I caught up with Kate Johnson. She's CEO of Denver-based Lumen Technologies, and 300 of her employees have been using Copilot for over 2 months now. Here's what she told me.
What I see is the potential for breakthrough productivity. I really feel like with the pace of diffusion of AI, it's now or never. You wait, you're gonna get left behind.
Now, I also spoke with one Lumen employee who told me Copilot allowed him to be in 2 places at once and even catch up on his missed meetings. Here's what he said.
Before I was using Copilot, that would have taken me probably a couple hours. It took me 3 minutes to be able to interact with Copilot in a Teams meeting.
That's wild, bro. And see, the undertone to this is not just that it went from a couple hours to 3 minutes. That's fine. The undertone to this is increased in GDP writ large because of increased productivity. 2024, if this ends up becoming mainstream across not just Microsoft's AI products, but other companies' AI products, that might be the year where we actually see an increase in productivity, because 2022 was horrible for productivity, which increases GDP without having to have a monstrous change to the economy, which might end up being the catalyst that gets us out of inflation and also keeps the economy strong, even with rising interest rates.
And bring that information current.
Now the pressure is on to sell that experience to the more than 300 million users across Microsoft 365, especially as companies are tightening their IT spending. I caught up with Microsoft's VP in charge of that business, Jared Spataro, on how he's pitching Copilot to customers.
We don't say, think of this as an addition to your IT spend. We say, think of this as a way of literally revamping all of your processes in your company. Most customers are very interested in productivity gains. They're very interested in what it can do to create value. And so we're going to start there.
And more competition is coming. Google is also working on similar AI tools for its productivity apps, and it'll all cost the same as Copilot. But Daniel Newman, analyst at Futurum, tells me Microsoft has an entrenched lead over Google.
I actually believe Google will continue to be the leader in search, and Microsoft will continue to be the leader in these productivity tools. And that while maybe you'll see a few customers jump over the fence over time, I don't think that this so much compels the switching as much as it does really lock customers in.
So look, we'll see what happens a month from now, but Microsoft says sales from Copilot won't really kick in until later next year, guys.
What did the woman who you spoke to at Lumen, the CEO there, is she going to pay for this?
It sounds like it. She's very optimistic about it. Now, only 300 of her 30,000 employees are using it. And I asked her that, you know, when it's generally available, are you going to kick that up? Are you going to go from 300 to 30,000? She effectively said it depends. They have a lot of workers who are out in the field fixing equipment and things like that. Maybe they don't need Copilot as much as someone who's working in finance in the office.
What did the guy who said he was in 2 places at once mean? He missed a meeting and he just
Yeah,
went
so
back and looked at the video?
This is all happening through Teams. So let's say you have back-to-back meetings or you're late to a meeting. What Copilot can do is you log into Teams and it'll say, Becky.
Double the number of meetings? That does not sound like a productivity booster.
But you've had overlapping meetings before.
Yeah, and I'm really glad when I missed one.
Exactly. But what if your boss asks you what happened in that meeting you missed, which is what that guy told me. He was able to ask Copilot what happened.
And that's the killer app, because all that is right now is a transcript, effectively,
basically,
and a summary.
And summarizing it.
It's a transcript and a summary of the meeting,
right.
Which, by the way, is valuable, and it's timed to the video. So if you actually want to go back and see the video, you can do it. It's not. I mean, it's interesting.
It's interesting.
This technology exists already. The other question, by the way, is for all this stuff to work, at least for that piece of it to work, it does require recording everything.
It has to record everything. It's looking at all your emails. It's looking at all the, it's containerized and not public, of course.
Privacy concerns on any of that.
But Teams, to your point, that's the example most people bring up. It does things with Outlook, for example, like you can.
There's a lot of things that are going to happen with this new type of product, not just from Microsoft. I think they're undermining some of the productivity gains. Yes, the summary of meetings and the transcripts of it is one element, but I think there's going to be a lot more that Microsoft and a lot of these companies innovate on when it comes to productivity increases in your operational workflows. Yeah, like meeting transcripts are not the most exciting in the world. And honestly, every company, there are so many startups that are doing like AI powered meeting transcripts. I've seen so many of them. So, it's whatever, but there's going to be a lot more increases that happened. Now, this idea of privacy also, I'm seeing a lot of startups that are creating AI wearable devices. I mean, this stuff is kind of crazy, the stuff I'm seeing with some of these startups. Man, I wish I could find that picture. Let me see if I can just get it up real quick. There are startups now that are basically saying, hey, you should wear a necklace. And on that necklace, oh, I found it. Perfect. Here we go. Look at this. This is crazy. This is crazy. So this is called the Rewind pendant. Okay. So you wear this thing. Speaking of AI having to, memorize everything and try to make you more productive. Rewind pendant is a wearable that captures what you say and hear in the real world and then transcribes, encrypts, and stores it locally on your phone. I don't know, bro. This is like on first glance, it okay, so everything I say throughout the day is stored, and then I could go back in time to what I was saying on January 34th on a date or something, right? Like there's so many use cases you can imagine of this. But just imagine if this stuff leaks. There's probably shit you say throughout the entire day that you don't want anyone knowing about, right? It's like a really private thing. So it seems cool, and I'm sure there's people that would do this. But it's interesting because if somehow this stuff gets out from your control, then it wouldn't obviously be the best. Now, granted, I could see a lot of use cases just throughout work, throughout life. You're meeting with a certain friend and you want to remember what the conversation was about because you're not recording it. You're not on, you're not Snapchatting that. Snapchat is the initial kind of way to keep the memories, or Instagram, right? These types of social media platforms, but it's not literally, unless you're recording for the full 2 hours, you're hanging out with a friend you haven't seen in 5 years. You're only getting a gist of that memory. Whereas this thing is recording the whole conversation, and you could listen to it again when you're old and be like, oh, I remember when I met with Becky 5 years ago. So I feel like there's some use cases there. I just don't know if it's something people would genuinely want to do every single day. Everyone becomes James Bond with wearable IoT devices. Yeah, some Black Mirror stuff, definitely Black Mirror-esque for sure. But I do think there's a use case in that. I genuinely do think there's, because for example, my parents didn't really they recorded a lot when I was little, 2-3 years old, but it was on old cameras, and I don't have any of that footage now. And so I would love to see, what I was like at 2 years old, 3 years old, and watch those videos, and I have none of them. And so the idea that, a device like this could kind of capture those memories without having to always record it, but it's just always being recorded, especially when you have little kids, I feel like that's useful to some extent. And there's probably other use cases of it, but it begs the question, is it worth it from a privacy perspective? All right, we have some breaking news here. Let's transition to this. Cruise has just run over a woman. Cruise has just run over a woman. A self-driving car owned by General Motors Cruise ran over and hospitalized a woman in San Francisco. The woman has allegedly, she was trapped under the car for 30 minutes as the self-driving car was unable to drive. Cruise has released a statement. Okay, let's see what they have to say. At approximately 9:30 p.m. on October 2nd, a human-driven vehicle struck a pedestrian while traveling in the lane immediately to the left of a Cruise AV. The initial impact was severe and launched the pedestrian directly in front of the AV. The AV, the autonomous vehicle, then braked aggressively to minimize the impact. The driver of the other vehicle fled the scene, and the request of the police, the AV was kept in place. Our heartfelt concern and focus is the well-being of the person who was injured, and we are actively working with police to identify the driver. Well, that's not good for Cruise. That's not the best for them. So technically, the other car struck the pedestrian, and then that car that struck the pedestrian launched the pedestrian into the Cruise's lane, and then the Cruise couldn't keep driving because they were stuck under them, and so it stayed. That is the story from what I'm understanding right now. Look at that. There's the Cruise right there, and they got it stuck right there. You know, it's a problem that's going to continue happening with Cruise. Obviously, when Tesla FSD becomes a thing, I'm sure we'll see some of these problems. The thing is, Tesla FSD, they've had some problems, but I don't think it's had as nearly as bad publicity as Cruise has had. I know Dan O'Dowd tries to, make Tesla seem like the worst company in the world with their FSD, but outside of running a stop sign that was not that bad from that video a couple months ago, I think Cruise has had worse publicity. So it's really not been the best for them. Matt says, crazy how other self-driving companies are going to hurt Tesla self-driving. Yeah, and see, the problem is the stigma of self-driving. By the way, Tesla recovered pretty nicely yesterday. It was down about 4% after the delivery numbers came up about 5%. The one bad thing about all these self-driving cars is that when something bad happens, it creates a stigma. Just like EVs with range anxiety, it creates a stigma at the end of the day. And people, it's hard for them to get that stigma out of their mind that if they're driving that car, they might potentially be part of a crash or some type of thing that ends up happening that's bad. So it'll take time for that to normalize, but definitely not the best thing in the world for Cruise. June says they're going to pay her a lot to make that go away. Yes, that is. And it's San Francisco. Yeah, that's going to happen. So by the sounds of it, wasn't a Cruise specific problem, but could have happened to a human driver as well. Yes, that's what it seems like, Harmsy. The problem is the headline is it's a self-driving car that was in the mix of this. So they're probably going to deal with that issue. Bay Ray says Cruise couldn't get over the hump. Yeah, that is also true. Okay, let's get an update on student loans. Student loans are starting very soon. This is going to have a big, big impact in the context of discretionary spending for the economy, along with potential forms of deflation. So let's take a look at this, and then we'll talk about SBF.
Millions of Americans will resume payments on student loans this month when a pandemic-era freeze expires. 40 million people collectively owe more than $1.6 trillion. For more on student loan forgiveness, spending, and debt, we want to bring in Mitch Daniels. He is the former OMB director for President George W. Bush. He's a two-term Republican governor of Indiana, and until very recently, he served as the president of Purdue University. During his tenure at Purdue, he commenced a series of tuition freezes after 36 years of tuition increases. And we'll talk to him about that, too. Mitch, thank you very much for being with us this morning. I know that you are hugely opposed to the debt forgiveness program. When I was talking about it a little earlier, people on Twitter already started writing in saying, oh, this is a 1%er issue. The rich don't want to pay for the rest of us who have these loans that are smothering us. What's your response to that?
I think it's a complete misreading. I think this is remains the least defensible domestic policy suggestion in memory. It's a reward to the affluent and the people who will be affluent. That's one of its many flaws. It is brutally unfair to those who did pay their money back. I served a school where 99% of the graduates do pay it back, and now they would have a right to feel foolish if others were let off the hook. The moral hazard problems are obvious. Terrible moral example for the future. It'll exacerbate the college cost problem because we know that subsidies like this, as they increase, are largely pocketed by the schools. But it still has the constitutional flaws it always did. It's an attempt to spend unbelievable amounts of money without the approval of Congress. So. They give them points for persistence, for trying again, but a terrible idea remains a terrible idea.
Mitch, I think some people misunderstand it just from the idea of loan forgiveness. It's not loan forgiveness. It means the borrowers don't have to pay the money back, but taxpayers do. And that often includes people who don't go to college.
Yeah, it's a very important point. That's a misnomer to call it forgiveness. It's a transfer of the obligation from people who borrowed the money to people who didn't, and including, as I just said, millions who accepted the obligation that they had taken on and paid it back. And on top of all that, Becky, a nation that's 31 trillion in debt and rising fast should be doing everything it can to slow that growth and eventually flatten it and not exacerbate it as this would. So, I think that it's a pretty transparent exercise in vote buying.
So one thing that he makes that's a really important point is, number one, it's definitely vote buying, right? Biden wants to get people's votes. And look, the Republicans will want to buy people's votes. Democrats wants to buy people's votes. That's just natural. It happens on both sides. But student loans is definitely a practice in vote buying because it's just not a feasible thing to do. Second of all, what he's saying about inflation is really true. If the government actually enacted Biden's executive order of canceling $10,000 of student debt per every borrower that makes $125,000 or less, and by the way, I'm one of those. I literally have $10,250 in debt. So I mean, if he had wiped out my $10,000, I would pay $250 and I'd be done with student loans forever. We would have printed $450 billion. That's the analysis, or that's like what I was reading yesterday. $450 billion we would have to print. We wouldn't be taking it from taxes because we don't have enough in taxes that we would have to literally print. And I think Jay Powell, even though he's never commented on student loans, is probably like thanking God every night that somehow the Supreme Court stopped the student loans process from happening, because just imagine in this, very tight economic environment around inflation where it's coming down, but it's not coming down aggressively enough. We would print another $450 billion. Now, the counter argument is like, okay, well, students would not have to pay that money. So they would have more money to pay in, other elements of disposable income, and that would help the economy. That would still be bad. Number one, $10,000 off of like a $200,000 or $400,000 or $50,000 loan is like not, you still have to pay back that loan, right? So it's not like that matters. I mean, it might help you, sure, it definitely helps, but you still have to pay back the loan. So money would still be going away. Number two, if your 10,000 wiped out your student loans or wiped out a significant portion of it, and you put that money back into the economy, we would have more concerns around inflation. Because for 3 years, students didn't have to make those payments, which is why more money piled into the economy, which is definitely one of the reasons for why inflation continued to rise. It's actually a catalyst for deflation if you have some of that money, $300-400 a month, leave the economy, and you have a better chance of eventually stocks doing well if inflation goes down. So I think all in all, even though I have $10,000 in student loans and I would love for that to have been canceled, I am less naive than I was back in 2020 when I got the stimulus checks, because those stimulus checks, quite frankly, if the inflation we're experiencing now, it's not worth it, right? It doesn't seem like it was worth that at all, even if it offered some temporary relief. And maybe we could have done stimulus checks, but just not as much as we did to offer some relief, or maybe more targeted stimulus checks, something that would not have printed that much money, because printing another $450 billion, I don't know if that would have helped. I really just don't know if that would have been the best. Obviously, as Abraham says, student loans are a problem. Cost to go to college in 1980 was, $10,000. Now it's $200,000. There's a lot better solutions we can solve it with student loans. But the problem is colleges don't want to adopt that story because colleges want to continue to spend money. All right, let's move on to the SBF saga. So here's a clip before we get into everything going on. And this was just, I don't know if you guys have seen this yet, but this was just a fascinating clip I saw last night about what SBF was willing to do to not get Trump to run for president.
In this book, I thought, came with this revelation that Sam had looked into paying Donald Trump not to run.
That only shocks you if you don't know Sam. Sam's thinking we could pay Donald Trump not to run for president. Like, how much would it take?
Did he get an answer?
So he did get an answer. He was floated. There was a number that was kicking around, and the number that was kicking around when I was talking to Sam about this was $5 billion. Sam was not sure that number came directly from Trump.
Wait. So Sam's looking into paying Trump not to run, and he actually might not have come from Trump himself, but he actually got a price?
He got one answer, yes. The question Sam had was not just is $5 billion enough to pay Trump not to run, but was it legal?
Well, why didn't this happen? Why didn't you follow through?
Well, they were still having these conversations when FTX blew up. So why it didn't happen? He didn't have $5 billion anymore.
Approached for comment by 60 Minutes.
That's wild, bro. That's insane. Like, so the dude basically was like, look, I've got so much money. And I think the reason he didn't want Trump to run is because he thought Trump was an existential threat to democracy. That was his belief. And as a result of that, he was like, well, can we just pay him money? And I don't know if Trump gave that number or one of his advisors or whatever, but $5 billion the guy was considering putting up to just get Trump to not run. He also invested with Mitch McConnell in a lot of Republican candidates. He had a meeting with him in 2022 to invest in candidates that were anti-Trump. So the guy definitely did not like Trump at all. He was one of Joe Biden's largest super PAC donors. And one of the things that's interesting about SBF is that he made his billions in trading crypto via Alameda Research, which was his first company. And that's what triggered him to start FTX. The whole point of starting FTX was needing a better exchange to trade crypto on because he was already making billions in trading crypto. He was like, what if I have something that makes it better? And once he realized that owning the casino was better than just playing in it in terms of what FTX could become, that's where, you know, FTX turned into one of the biggest enterprises we saw today. There were venture capitalists that thought FTX would be the next Google. It would be the next Apple. SBF would become the next trillionaire. SBF had paid $55 million to Tom Brady for 20 hours a year for 3 years of endorsement. He had paid $35 million to Steph Curry. I think he paid like $10-15 million to Shaquille O'Neal, paid $100 million to the United Airlines Arena in Miami for the Miami Heat to get the naming rights. Like, they were just throwing so much money. Obviously, the YouTubers that were making money off FTX were getting a reported $50,000 a month just to say FTX for 30 seconds in like 8 videos. It was just insane, the money they were throwing around. And all in all that money was coming from clients that had invested money into FTX in terms of using it as their crypto brokerage. But because FTX was not able to hold bank accounts, all that money went into Alameda Research, which was able to actually conduct transactions via bank accounts. And because that money was stuck in Alameda Research and never came into FTX, Alameda Research ended up playing with that money. And when crypto crashed back in October of 2022, that's when Binance CEO let the world know that FTX has an issue. And that's when there was essentially a bank run on FTX. And that's what led to the collapse of FTX. But there was, a lot of hope for this company becoming the next big thing.
In the criminal trial of Sam Bankman-Fried kicks off at 9:30 a.m. in a Manhattan federal court downtown. Now, Bankman-Fried, who, remember, has been sitting in jail since August after having his bail revoked for alleged witness tampering, faces 7 criminal counts related to the implosion of the crypto empire that he built. Those charges include wire and securities fraud, as well as money laundering. What prosecutors are saying is that the former FTX chief misused billions of dollars worth of customer money for things like personal purchases, such as buying more than $200 million worth of luxury real estate in the Bahamas. The government also contends that Bankman-Fried was using these customer deposits to both cover bad bets that he made at his crypto hedge fund Alameda Research and to make $100 million in campaign contributions. All in, we're talking about more than $8 billion worth of FTX customer money that went missing. Bankman-Fried has pleaded not guilty to all charges, but if convicted by a jury, he could end up in prison for more than 100 years. Frank?
So, Mac, what else do we know so far about the trial? Will Sam Bankman-Fried testify, or do we expect some other star witnesses?
So we're looking at a 6-week trial with prosecutors expected to take a month to make their case. We don't yet know whether Bankman-Fried will testify, but the witness roster is expected to include his top deputies at FTX and Alameda, who also used to comprise his innermost social circle. That includes Bankman-Fried's ex-girlfriend and former Alameda CEO Caroline Ellison, as well as his ex-best friend from high school math camp, Gary Wang, who co-founded FTX. Both pleaded guilty in December to multiple charges and have been cooperating with the U.S. Attorney's Office in Manhattan for months.
That's the worst, bro. That's the worst. That's how you know you're screwed. When your best friends and your ex-girlfriend are like, yep, we're guilty. What do we need to take for the plea deal to rat on SBF? How much can we reduce the jail sentence just to, that's when you're screwed, bro. Like, when your best friend, your co-founder, and your ex just plead guilty, they don't even put up a fight. They're like, yep, we're like, what's the best deal you got? Can you give us 2 years instead of 20 years? And we'll rat on SBF. We'll get that motherfucker to get, 100 years in jail. That's how you know. I don't think this is going to be a good trial for him, because everyone close to him, like, what is the defense's case going to be? Prosecution obviously has a myriad of arguments. Is the defense going to claim he's crazy? Are they going to claim he's, he has Asperger's or something? And it's like, the dude built a $30 billion company. Like, he can't be that quote unquote special, I guess, to when you're building that big of a company, right? Like, you're just irresponsible with people's money, which is a whole different thing from being kind of crazy or insane. So I don't know if they can go the asylum route. I think they're gonna have to go the it wasn't criminal negligence, it was just like stupidity. And I don't know if they get away with that, bro, because it seems too obvious that this was negligence versus just being dumb. It's a hard defense for them to say. Vinay in the chat says SBF stole his money, lost 50K. Yeah, it's tough, man. A lot of people lost a lot of money on this. So I could imagine there's people that lost like millions of dollars on FTX. Vinay says FTX was one of the best exchanges for trading at the time. Many traders folk to that exchange because of the user experience it offered. Obviously, no one expected this fraud from the guy with the MIT background. Yeah, and that's also the crazy thing as well. The guy graduated from MIT, was incredibly smart, and then immediately screws people. And it's crazy because when VCs thought he was going to be the next trillionaire, like legitimately they thought he was going to be the next trillionaire, they wanted to believe he would be the next trillionaire because of his idiosyncrasies, right? Like the idea that he was on a national television for the first time and he was playing League of Legends or whatever he was playing while on the TV interview. Like, you could see his eyes going back and forth from the game to the interviewer. People thought that was eccentric enough to take a bet that he was going to be the guy to be crazy enough to like be the trillionaire dude, be the dude that like no one expected to win, especially because he was a nerd and he was like a smart nerd and he wasn't that social. So people thought, oh, this is like what it's supposed to be like to be a trillionaire. And I think they're not wrong for thinking that. It's just there are some types of people that when they act like that, they also have a dark side to them. And that dark side is, end up being very manipulative in terms of what they're doing with other people's money. Obviously, Elon is the exception, right? That dude is crazy, keeps building great companies. But Elon does have some social skills, right? Even though I know people say Elon has horrible. So Elon can actually like present himself, talk to an audience. He can get emotional. This SBF dude just like seemed like he didn't care about anything. And as a result of that, had these issues. Also, Elon's not as political. I know Elon tweets about politics and he's going to the border and all this shit. But SBF is like legitimately trying to stop certain candidates from getting elected. It's like Elon, I don't think cares that much. I don't think Elon's ever donated. And I mean, Elon, it's just Elon's voted for Democrats. He's voted for Republicans. This SBF guy seems like he has a mission on who he wants to get elected. And that agenda as well is also very weird, given you would think he's apolitical and he doesn't care about this type of stuff because all he wants to do is make money and play World of Warcraft. But I guess he just does care a lot about that. Daryl says negligence isn't a legal defense. Yeah, I mean, that's also true. So it's going to be tough all around for SBF. We got about 7 minutes until the market opens. Before we get into that, let's get a little bit more coverage on the big 7 tech stocks and see where they're at for a couple minutes, and then we'll get into the charts. Here is an analyst saying that the current valuations of big tech simply cannot last if we have a slowdown going into Q3.
Portfolio manager at DCLA. He's also a CNBC contributor. I think it just trying to distill down what you're thinking, Surratt. I think the base case now is higher for longer, but what we don't know is higher than we are right now for longer or where we are right now for longer. We still don't know. We could go a point or two, theoretically, 100 or 200 basis points higher before this is all said and done, depending on inflation and how strong the economy is.
Yeah, and I think that's what's causing a lot of this volatility, Joe, because the market's trying to figure out where we're going to go. And when it doesn't know where we're going to go, the first thing it does is sell. So you see that in interest rates, you see that in the volatility of interest rates, and then you add to it the uncertainty of other things going on, such as oil prices, the dollar getting stronger. And then, just because we don't have a government shutdown, it just means we kick the can down the road. And you could say the same thing about interest rates. So you add all that, it's a very powerful cocktail to say, hey, you know what? Why should I actually, in the short term, kind of be invested in the market when I can get 5.5%, 6% just sitting in treasuries? So I think shorter term, there's potential for much more volatility, but longer term, when this thing settles out, what we're seeing is a huge valuation disparity between the big 7 and now the rest of the market. It's getting bigger and bigger.
Well, I wish we knew exactly what dictates further rate hikes, Surratt. If it was just inflation, that would make sense to me. You want to keep going up until you conquer inflation. But it almost seems like as long as the economy holds up, the Fed thinks that it needs to go higher. It's almost like a catch-22. To accomplish their goal, which is slowing the economy, they need to keep raising. And it hasn't happened. That's why the rates are going up now. Every strong economic number we get causes rates to tick higher with the notion that the Fed's not finished.
All right. End phase. We got some breaking news, everybody. So what he's essentially saying in that video is like, look, big tech is not going to be able to survive if Q3 slows down, because if interest rates stay even high for longer, if not higher for longer, then big tech valuations are a little bit stretched. Now, granted, I think it's stretched to an extent. I don't think big tech is that expensive as we all think. Obviously, Nvidia is a little bit expensive if you look at it on a PE basis, but there are other companies like Google. I think at a 28 PE is not crazy expensive. Does it go back to 15 like in 2022? Maybe, but could it go to like 23? Sure. Does it have to be, 10? Or does Meta have to go back to 8 PE? Probably not, right? So as much as he's saying the big seven can't survive, I don't know if they decline as badly as he thinks they are if Q3 is bad. End phase at 115.50. We are officially at a 52-week low for end phase. We broke out of that $116 level. This is big news for end phase. End phase has held up at 116 very well over the past couple months. I mean, 116 was always that support. 115 we're down. And if we go down from 115, 114 is there, 113. It keeps going down. And the reason we're seeing this, if you're just joining, is the 10-year treasury yield in the United States of America is giving a 4.7% yield. It's the highest yield in 16 years, almost 2 decades. And as a result of that, we are seeing a lot of red in the pre-markets. Palantir is down at 15.57 after being up at 16.30 yesterday. SoFi, 7.74. Tesla down at 2.48, down 1.3%. PayPal is down 0.96. I did end up buying some PayPal yesterday. So I got to reduce my average on PayPal pretty nicely, but PayPal is down. NASDAQ, 13,307. That's probably going to open up down maybe 100 points. S&P 500, 424, down about 3 points. It's going to be a red day because those 10-year yields are spooking a lot of algorithmic traders and probably a lot of institutions. And so the question becomes, do we get low enough where the dip gets bought today and we start to get in a position of capitulation over the next couple of days? Or does the pain just really get bad because those 10-year yields are not exciting to a lot of investors? And so we're going to see. Obviously, 80, if you've seen some of the technical analysis on end phase, is the next gap to be filled or the next level of support for end phase. So 80 is very possible. One thing Vitaly was saying yesterday on Finance Junkies is if management says Q4 is not going to be good, this thing's falling badly. And so if you want to DCA on end phase, you have to make a decision. Like if you have $10,000 to DCA with, maybe you put in 5,000 now and then wait till after Q3 to put in the next 5,000. But if you really want to get the bang for your buck and you believe Q4 is going to suck, what's the logic for why Q4 is going to suck? Well, solar needs financing, which needs interest rates. And it doesn't seem like interest rates are coming down until at least May of 2024. If that's the case, management probably should guide, unless internationally they figured out a way to grow better than the United States. They should guide down for Q4. It seems like that's going to happen for end phase, and then end phase is going to be in a tough situation. And that if that happens, under 100 is very possible for end phase. So it's something you want to be kind of, if you're into end phase, you got to really think like, where is the better avenue for me to come from if I want to start buying the dip. The fear and greed index is at fear. I believe it's at like 24 or something. I tweeted it last night. If you're not following me on Twitter, please make sure to follow on Twitter. The link is in the description. We're at 28. We're at 28 on fear. So we're not at extreme fear yet. I think we have like a couple points down to go to extreme fear. And then we'll see it from there. Dejuki says, everyone is going to time the bottom. Who cares? 116, 180, if it's going to be 300 in the future. Yeah, I mean, that's possible. Look, 300 is possible. Remember, just because it hit 300 before, it doesn't mean it's going to hit 300 again. Is it possible? Yes. But would you have to wait 5 or 6 years? Yes. Would you have to wait maybe 2 years? Maybe. It's like you really have to be a long-term bull on end phase. And remember the opportunity cost of waiting for it to go back to 300 because 300 was a different time, right? So could it happen again? Sure. But it just might take some time to get there. And that's why it's important to kind of think when you want to do your DCA. All right, October 3rd, 2023, 9:30 a.m., 10-year treasuries at the highest level they've ever been. Let's see what happens to the market. The stock market's now open. Wake your ass up. Here we go. The stock market is officially open. What do we got? Well, we got Enphase under 115. Enphase at 114.80, down 1.75% as we open. Google 133. Google pretty flat. I mean, it's down, but not down a lot. So Google holding up nicely. Tesla 248, down 1.2%. Also holding up not too bad from yesterday. Snapchat down 1.6% at $8.60. SoFi $7.72. SoFi is down pretty aggressively. We are seeing SoFi get hurt a lot, along with a lot of other fintech today. Elf Beauty, $105.97, down 2%. Palantir, $15.67, down 1.29%. PayPal, $57.95, down 1.04%. I think we were at 59 yesterday on PayPal, so down $1 today on PayPal. Neo, $8.63. This one was up last week, down 1.82% today. Rivian, $22.24. They beat on their deliveries and their production estimates, still down 2%, but definitely did well on deliveries and production, just obviously not as well as Tesla. NASDAQ, 13,223, opening down 86 points. S&P 500, 425, opening up a little bit higher than what was yesterday at 424, or in the pre-markets at 424. So S&P at 425. Again, $5 away from the 200-day moving average at 4,200 at 420. So we're going to see if we get there. Instacart, $26.83. If you bought the IPO, you are underwater by $5 on Instacart. Unfortunately, it's just what happens with some of these IPOs. ARM at $51.75. So ARM still 68 cents above their opening IPO price as well. Ginkgo Bioworks, $1.68, down from about $2 it was at last week with the Google partnership. Meta, 303. Meta pretty much untouched. Nothing too bad happening to Meta. Square continuing to fall down to 42.53. It was at 45 yesterday, now at 42. Microsoft launching Copilot November 1st, 320 on Microsoft. Arc Innovation, 38.52. JP Morgan, Bank of America, these stocks are down. I think the regionals are taking a hit today. Let's take a look at them. I'm pretty sure. Yeah, look at that. Truist at 27.25. This is at levels of May. Truist was at. So now Truist, this is getting to their 11-year low. Either the market buys them up or it breaks that 11-year support, and we'll see what happens. But Truist and all the regionals getting kind of hit today. Robinhood at $9.60. KRE Regional Banking Index Fund at $40 currently. Zions is down. Key Group is down. Roku is down 69.59. Zoom is down 69.53. Target is up today at 107.19, so up about 40.47%. And Nvidia, for some reason, is green today. Nvidia took a nasty hit a couple of days ago. So Nvidia, not bad. It was at 412. Now it's back at 448. What else do we have? The Enovix. Let's check into Enovix. Enovix also got hit pretty badly. Enovix at $10.55, down 10%. I don't know what the news is on Enovix for why it's down this bad. For those that don't know, this is a battery company. Former Enphase dude is running the ship on Enovix, TJ Rogers. So, people have a lot of faith in this company to be able to do well. It's one of those companies where the market cap is like, $1 billion and their revenue is like 40,000. So like literally $40,000. So they have a lot of work to do to justify that market cap, but it is down today at 8%. Upstart 27.18. They're down. Mercado Libre is down. Duolingo is down. Duolingo is still up pretty nicely from the past couple of weeks after their monster earnings, but they are down as well. Open Door, $2.57. Open Door was almost at $5 at one point back in July. Uber, $45.52. Uber, the stock that never moves, the stock that's basically destroyed shareholder value unless you bought it at the COVID lows. I mean, 45, it's been stuck there for so long. I can't justify buying Uber, bro. I don't see the shareholder capital value appreciation at all. And maybe there's a bull case for it, but not at a $93 billion valuation. They made the VCs rich. I don't think they make average investors get rich. Nvidia again at 447, Target 107. Nike is green. So we have Nike, Nvidia, and Target that are green in a sea of red. Interesting. Nike had a great earnings and Nike is green. Nvidia somehow is green and Target is green. Bitcoin falling from the 28,590 level. So we're seeing Bitcoin get back down to some of the normalized levels it was at over the past couple of weeks, 27,513 on Bitcoin, which is why Coinbase is down 1.6% today, 1.86% today, as we're seeing it get to $73. It's a red market. It's not as red as I expected. I actually thought it would be worse today. Like, I actually thought it would be even more catastrophic, but now you get to those levels like Enphase now at 115, right? Recovering from a little bit of the 114, Tesla at 247. It was just at 248. Now you see if the big money comes in and decides if they want to start buying up some of these equities that have collapsed this morning, down 1 or 2%, 1562 on Palantir because of that 10-year bond. And so let's see kind of over the next 30 minutes where it goes. Snowflake, let's take a look at that. 150.81. Snowflake not down too much, down 0.24% as well. Wow, this is a lot of red. And again, it's just because of that 10-year. Let's get an update on the 10-year and see where it's at as well. That is the reason for why we are seeing the decline that we're seeing today in the stock market. Yep, 10-year is still holding strong on to 4.7. 4.722. So if you don't want risk, if you don't want to put your money into the equity markets, this is where you put your money. And we would see a lot of people buying up that U.S. debt versus having to buy U.S. equities to be able to make the decision. You know, it's so interesting because if you buy U.S. debt, obviously the U.S. has more money to finance all their operations. But if you buy U.S. equities, GDP of the United States, theoretically, the economy, the health, all those factors you care about should do well. And the economy in general, right? The United States should have more money to kind of pay off their debts, tax revenue, all that stuff, because the U.S. companies are doing well, because the stock market is doing well. So either the U.S. economy does well from people buying equities, or the U.S. economy can finance their debt from people buying bonds. And it's this push and pull that we have throughout the economy to figure out which one is the best one to be able to invest in during the current economic time. Franco says markets will get bought up by the end. This is what I'm seeing as well. I mean, if I had to guess, I would say that's the case as well. Palantir now at 1563, because again, this S&P 500 200-day moving average, we haven't broken it yet. Honestly, yeah, 422, we got close right now at 425. Until we see a nasty fall, like a real massive red candle to get us back to that 200-day moving average, money comes in and it steps in at this 424, 423 level and it buys it up. And if as what Ryan says, it seems pretty simple that the Fed is going to break something before they cut. If something breaks before the Fed cuts and the Fed doesn't have to cut, then we would definitely see an inflow of capital coming in, because then prices are going to get ridiculous and people are going to buy. But we will see, where the market ends up taking a lot of these things. Speaking of bonds and stock prices, let's actually get a little coverage on this. Here's an analyst talking about why they are disconnected from the fundamentals we're seeing in the economy right now.
At least according to JP Morgan, where good news is bad news, avoiding that shutdowns, driving yields higher, according to their research. Do you agree with that thesis that deal to avoid a shutdown is right now, currently, the primary catalyst for yields to move higher?
I think it certainly has been, and the market is also moving a bit in the wrong direction, I think, on most of the data we're seeing. And I do agree that we are somehow a bit disconnected from the fundamentals. So if we look at something like inflation, which should have been the core driver of yields, we saw it earlier this year when we saw surprise on the upside on inflation. Market is somehow dismissing those kind of data points. So if we look at 3-month annualized moves on core PCE, we have 2.3%, which is something that should put the Fed in a mood to think more about the rate cuts. But at the moment, it's really the strength of the U.S. economy, the avoidance of this shutdown, which is pushing yields higher.
All right, so one thing we're watching in the United States is inflation and how that's going to impact the Fed's decision. In fact, Fed Chair Jay Powell in rural Pennsylvania talking to small business owners, getting a bit of an earful about these higher rates. We're also seeing on the markets, the Russell 2000, that's our small cap index here in the U.S., in correction territory right now, 10% off of its lows. Do you believe that still remains a leading indicator of a possible recession?
I don't think we're going to see a recession in the US, but what I do think we're going to see is an economic slowdown. So what the yields are doing is essentially tightening financial conditions. And what we're seeing with the companies in the small cap index, they both have tighter financial conditions. This means higher rates. They're going to have to pay higher credit spreads, but also the availability of credits from the banks, where we're seeing definitely tightening lending standard, is something that's going to move a bit against us. On the other hand side, we're also starting to see some value in some of these stocks. So I think small cap looks attractively valued. We like some of the equity laggards in the US. So when we move outside of the surging 7 stocks, we see the S&P 500 trading at 15 times earning at a time where we still think we're likely to see a peak in yields very, very soon. And we do think there's a little bit of a Fed bluff in the sense that we do think that they will cut interest rates next year on the back of inflation that is falling, an economy that will start to slow, and they know that they're putting in a restrictive territory and monetary policy at the moment.
All right. So what he's saying there is actually really important. Small caps, and I've heard a lot of analysts say this, small caps are actually really exciting for investors right now, primarily because if you take out the big seven, the S&P is not trading at 22, 21 times earnings. They're trading at 15, which is, if you factor in the growth we're going to see in earnings in Q3, the S&P trading at 15 times earnings is not the craziest thing in the world. You just have to find those companies that are still undervalued, that have not put up the amazing earnings that big tech and the Magnificent Seven have this year, and try to invest in them. On top of that, if you believe the Fed is bluffing, which he believes as well, then you've got a series of catalysts coming up. You've got the S&P 500 trading at a not that overvalued level if big tech is factored out of it, which means the Russell 2000 and small cap is doing well. And as a result of that, if the Fed starts to lower interest rates, that means those small cap stocks, which are more kind of growthier names, are going to just grow more, right? Their equities are going to get those premiums because the cost of capital is coming down. And you're going to end up setting yourself up for a good 2024 for small caps. The question becomes, do we avoid a recession? Does inflation come down? And does the Fed actually cut rates before they say they're going to cut rates? Is the Fed bluffing? And that kind of depends on something in the economy breaking for the Fed to actually be called out on their bluff. Truist falling below 27, right there at 26.97. So we're seeing a lot of pain in the regionals. The regional banks are getting cut up. If Truist is falling, obviously SoFi is going to be falling. PayPal is going to be falling. All of fintech and banks, if you see all that red, $58 on PayPal. JP Morgan, Bank of America are down today. We're definitely seeing a lot of red everywhere. But more importantly, on the banks. The banks have a tough thing to deal with these interest rates being high. It's something that eventually I think the Fed is concerned about in terms of all the losses they're holding on their portfolio. And if the banks fail, the entire economy fails. So you don't want the banks to fail. But they're going to have to wait till interest rates come down. There was some good analysis actually on this that I want to share by our good friend of the channel who tweeted this today. One of the reasons why banks are in the issue that they're in, and this is Chris, he tweeted this morning, is primarily because of the new regulations that are happening right now. So one of the significant advantages that regional banks have enjoyed over the past 5 years is the exclusion of the AOIC, accumulated other comprehensive income, from their capital requirements. The proposed rule changes threaten to remove this exemption. So the current issue at hand, and this was being debated over the past, I think, 3 months now, this was introduced in July, is that most regional banks play a unique role in providing financing to small businesses. Alterations in the regulatory framework could severely restrict the availability of capital, consequently harming small enterprises. What he means there is that basically the United States government is saying that regional banks and every bank in general has to hold more money in reserves in order to be able to do business. And regional banks have had the luxury of not having to hold that much money in the reserves in order to conduct business. This proposed rule change is not set to take effect until 2025. So currently, a lot of the regional banks are unaffected, but they're going to take every possible measure to bolster their CET1, which is their common equity tier 1 capital levels, which is the amount of money they're going to have to save in their reserves. Now, here's what happens. If interest rates were to decline over the next few years, the paper losses in their AOCI, which if you mark to market their loans, are pretty dramatic. I mean, we're talking about, for Bank of America, hundreds of billions of dollars, for Truist, probably tens of billions of dollars on their balance sheets, would diminish significantly. Like, even if rates go down 25 basis points, even 50 basis points, you are going to see a dramatic increase in the availability of capital that these regional banks and overall big institutions, big banks have, thereby increasing the available capital for lending by banks. If they have more money to lend, they have more money to be able to make on the interest of lending. Their net interest income margins get higher because they have more money that they're lending out. Overall, it becomes a way better thing for the economy. Given the emerging lower inflationary environment, in my opinion, Chris says 2 potential catalysts could trigger a rally in regional banks. The regulatory framework changes or may be postponed or revised to ensure an adequate supply of liquidity for small businesses, which is very reasonable. This regulation isn't law. It's just proposed regulation, so it's possible that it gets changed. And second of all, lower interest rates could reduce losses, allowing many banks to comfortably exceed their capital requirements. As you can see here in this chart, accumulated other comprehensive income at U.S. banks is down pretty badly in 2023. In 2023, it was positive, or 2020 it was positive. 2023, it's down. And these are the actual adjusted TCEs at the largest U.S. banks in Q2 of 2023. If that doesn't change, then it's going to be a tough situation for the American economy. And the Fed knows this. The Fed knows the banks are the economy. And if they keep raising interest rates, the banks continue to pile on these paper losses. And you can only last with those paper losses for so long. At some point, like that shit has to hit the fan. And so that's another reason. I mean, the regional banks are one of the big reasons I think the Fed is not going to raise rates in November. I just don't see it happening, given how badly the banks are holding these losses. If inflation is that bad, then sure, but I don't think inflation is going to be that bad. So we just have to see that play out. And if that's the case, it'll, hopefully not be too bad. Someone pointed out Verizon being down this much is nuts. I agree with you. I had a friend text me the other day about Verizon. Verizon still pays a 7% dividend, if I'm not wrong. Am I wrong on that? What's the dividend? 8%. Wow. 8.38%. It's at $31. And if we go to their high, they were at 53 in 2020, and then they were at, in January, 41. So basically they fell from 41 to 31 this year. The reason this happened is because in July, a news report came out about lead in the cables, in the Fios optic stuff that Verizon was installing for people, and how that would like cause diseases in people's houses. It was like this investigative piece that the Wall Street Journal did. And that was literally the catalyst that dropped them to like $10 in one, or dropped them $10 in one day. I don't know if that's that big of an issue anymore, but I do know that interest rates going higher has not been the best for Verizon. An 8% dividend on one of the most important companies in America. I mean, Verizon is still it's a staple for people to communicate from a internet perspective, a phone perspective, telecommunications, and you're getting 8.38% on Verizon. Now the question becomes, do you want 5% in a money market fund, or do you want 8% on Verizon that's down about 40% from its highs? And do you want to take the risk that Verizon doesn't fall another 40% due to something being mismanaged in the company? I don't know, right? And I think that's the problem that a lot of people are thinking about. June says they have a huge amount of debt. Yes, they do. They do have a huge amount of debt. That is one reason, but they've always had debt. I mean, they've had debt for a long time, and they've been able to maintain decent levels because shareholders, didn't really care, that because Verizon's good for the debt, right? Verizon will pay it off. The problem is, as interest rates go higher, that debt does get more expensive. Do you guys remember those commercials? I remember watching them on TV. Yeah, but can you hear me now? Those commercials were epic. Verizon was goated for those those commercials. They made it definitely part of the zeitgeist. Smitty says dividends on a lot of these companies are a value trap. You're going to lose more in the stock value going down. That is also possible. Walgreens is a great example of that this year. Walgreens definitely, I think it's down 44% this year, even though it has like a 9% dividend. I might be a little wrong on the numbers, but yeah, some of these stocks with the dividend. This is why I like TFC, right? Because TFC now back at $27. The dividend is 7.7%, and the fundamentals of this company are just absolutely gorgeous, especially if you look at it from a PE perspective. And the reason for why it had that nasty red candle in March is unrelated to the bank itself. It had to do with Silicon Valley Bank. Of course, TFC was going to be a casualty in that event, but this is one of the only stocks I think in the market that has amazing fundamentals, an amazing setup, an amazing growth story to come back to that levels from the stock itself, not even from the company, just given where regional banks will be if the Fed cuts interest rates. And they're cutting spending. They're introducing a plan to cut $750 million in costs over the next 2 years, and they're gonna have their earnings on October 19th. I will definitely be live streaming their earnings. So some companies offering a dividend have good fundamentals. Others might be value traps, and that's why it's hard to officially dive deep into them. Dividend stocks will fly when rates go down. Yeah, that's probably also going to happen as well. Let's take one last. So we got the bear case for why mega tech will do bad. Let's take a look at the bull case for why mega cap tech actually are looking really good after August and September.
We've been talking about rate pressure on the market. How do you see rates moving higher right now impacting the market today? As I mentioned, the NASDAQ turned in the red just a short time ago. Now it's back positive.
Yeah, so I think rates are going to be a nuisance for a little while longer. When you start seeing rates at this level, and you hear the Fed talking about being higher for longer and remaining hawkish, and then looking at that 10-year, that definitely impacts growth companies in particular. So I think for investors, they start to think about looking at the mega caps, the companies with the strong balance sheets that aren't going to be as impacted as this in the short term. But longer term, we have to sort of understand that we probably are towards the end of this rate hiking cycle. Perhaps they stay higher for a little bit longer, but we had 4 cuts on the schedule for next year. Now that's down to 2, but there are still cuts on the schedule for next year. So I think we're coming to the end of this rate nightmare, let's call it.
You're not. I've heard many times throughout this year doing this show that we're at the end of this hiking cycle. So we'll have to see 2 more meetings later this year. But you mentioned some weakness in some very well capitalized stocks, mega cap stocks, which you're looking at, stocks like Apple. So you say that right now is a buying opportunity. I want to ask you why now, as we see these elevated rates, you don't think these stocks will continue to slide? Apple in particular has a number of other headwinds, including possible restrictions in China.
Yeah, and those are all great points. But I think that if you look at Apple, it's fallen about 12% from its peak performance this year. And it's a great story there. So actually, iPhone 15 sales are much better than expected. It looks like consumers are starting to upgrade to the more premium models. They have billions of users that will then be captured into the Apple services ecosystem, which has incredibly high margins. The company's down to 26 times earnings versus 30 times. So there's a little bit of a discount there. And I think that mega caps are looking a little bit cheaper after this reset in August and September.
Okay. With all this in mind, Sylvia, what is your WEX word of the day?
Okay. We have 10 minutes until the JOLTS report. So I want to stay on till 10 and do this JOLTS report because I think this might be a market moving catalyst, but it's definitely going to be important in the broader economy to get these job numbers. So I do have CNBC Live, so I'm going to get that set up. And as soon as this comes out at 10 a.m., we should be getting the numbers on that, which are going to be super important. I believe it's JOLTS. Correct me if I'm wrong. If someone has I'm pretty sure it's the JOLTS report that's coming out today. And that's going to be very important because that's the job openings in the United States. And what that determines is it out today? Next release, October 3rd. Yeah, it's out today, 10 a.m. Okay, so we'll get it live. I can actually just use the website itself to get it live. Okay, so why does the JOLTS report matter? Ultimately, it's about job openings in the United States. Last month, we had a job openings report of 880,000, something like that. And we were expecting 980,000. That means we had 1 million less jobs open. And because we had 1 million less jobs open, stock market went up. Because as cruel as it is in the context of the average person getting a job, the market was like, oh, less jobs, less money, less inflation, stocks go up. Even though for the actual economy, it's not the best thing in the world. And, unemployment, we saw a tick higher to 3.8. Jerome wants to get it to 4.0 before it ends. And so before the 2023 ends. And so if we see that come down, I don't know what we were expecting. Let's just say we're expecting 800,000 jobs and we have 700,000 jobs. That's actually going to be really good for the economy today. That might be a real market moving catalyst. I don't know if it can compete that catalyst with the 10-year yield being where it's at today, but that's definitely a good sign that inflation is coming down because again, less jobs means more competition for those jobs, which means less wages. Right? The wage price spiral theory can't happen if everyone's competing for this one job because then employers have leverage and they can reduce wages. And if they can reduce wages, that means they're not overly excessively paying you for the cost of labor, which means productivity should theoretically go up. Corporate profits should go up. And then in general, you shouldn't have as much purchasing power if you're not getting paid these absurd rates to spend into the economy, which is overall going to be good for the macro in regards to inflation coming down. So going to be really important to see that report and see how it comes up from here. Time, 10 a.m. Eastern. Yep, it'll be 10 a.m. Arnie, thank you for being here. We got 500 people here versus 3K at Meet Kevin, Market Open Rocks. Yeah, I appreciate all of you people being here every day. Obviously, Meet Kevin, one of my inspirations in terms of just his work ethic to be able to do this. I've been doing the long format for 2 weeks now. Meet Kevin's been doing it for 3 years. So got a long way to go to try to get to those levels. Okay, while we're waiting for this job report, here's Jerome Powell, who has recently joined Instagram Threads, and this was his message to the Instagram Threads community for him now being on social media.
Hi, I'm Jay Powell. I'm the chair of the Federal Reserve. And I want you to know that the Federal Reserve is now on Instagram and Threads. The Fed is America's central bank working to promote a healthy economy and a strong financial system. That mission starts with you. October is National Economic Education Month, and throughout the month and beyond, we'll be posting here with information, links to events, and other resources about how Fed decisions affect you, your family. Hi, I'm...
You know what was so interesting to me about this? What was so interesting? First of all, he said, "Hi, I'm Jay Powell." He wanted to seem cooler than saying Jerome. Okay, he really thought if I change my name to Jay instead of Jerome, the younger crowds will feel what I'm trying to say. Okay, so that was the first issue I had with this. Second of all, and the second thing is not really an issue, but I just find it fascinating that the tech platforms that exist today, Instagram, Twitter, Threads, Facebook, etc., every institution in the world, I mean, we're talking about private companies to the biggest brands to startups to the Federal Reserve of the United States, has to use them because they have so much attention that if you are not on those platforms, you are missing out on getting your message across. And that to me just blows my mind that the Federal Reserve is like, yeah, we can't trust CNBC. We can't trust the Wall Street Journal. We can't trust Bloomberg to get our message out there. We have to go direct to the consumer on Threads where they're watching dumb videos of cats and memes and we have to educate them. Like, imagine scrolling through the threads and like seeing Jay Powell say what ET says in the chat, that the economy is hanging on by a thread. I don't think the average thread user would even care about the economy or understand why the economy is hanging on by a thread. But nonetheless, they're on Threads. They have to do what they have to do to get the message out there in the world. Okay, we got about 4 minutes to this jobs report. Before we do that, let me actually pull up one of Arnie's good pieces yesterday on Robinhood. He pulled this out from somewhere, and I don't know how he found this, but he found this. For those that are still investing or want to think of investing in Robinhood, I believe, and I think Arnie believes, it is one of the most undervalued fintechs in addition to PayPal on the entire market. Look at this. So this is what Arnie says. If you're not following him on X, please make sure to follow him on X. His profile is right here. Hoods is a secret money printer. Snacks is a free daily recap sent to 40 million subscribers. Snacks is their newsletter. Now Snacks is supported by ads. So let's do some basic math. This is on Robinhood's potential revenues. They send 252 emails a year, one per every workday. They have a 30% open rate, which is conservative because his subscription newsletter, Palantir Bullets, has a 50% open rate. So you would imagine Robinhood is close to 50%. And they're charging $25 per open for advertiser because it goes to 40 million people. So like 20 million people seeing your ad is probably worth $25 per open. That would equal $76 million in potential annual recurring revenue with literally 0% marginal cost. And remember, Robinhood acquired Sherwood Media, which is one of their media entities to help them promote the Robinhood the brand, information about money, markets, etc. So if they're monetizing that now with Snacks, which is one of the entities underneath that media brand, then you've got $76 million coming into the top line revenue for doing literally nothing, for paying somebody to write a newsletter, which is not that much money. And as you can see right here, the Snacks digestible financial newsletter is sponsored by Masterworks, which is like how you invest in high quality art in like fractional shares or whatever. That's a big deal. And then Alejandro reported underneath this that this is potentially going into the other revenue that Robinhood reports. So they report trading revenue, interest revenue, and then other revenue, which is not that bad at all. Arnie says it's not $25 per open, but for every 1,000. Yeah. So even if it's for every 1,000 opens, that's still a crap ton of money. An extra 10, 20, $30 million coming into Robinhood for sending out a newsletter. That only happens because Robinhood has a sticky user base that actually wants to consume their content. And I've been saying this for a long time. If you go to one of my videos back in January of 2022, I was saying Robinhood should become a full-fledged media company. I was saying they should acquire StockTwits. They should build out kind of a social Twitter for stocks trading platform within their platform. They should become the platform you go to talk about stocks and the economy, etc. Now, maybe they're not interested in doing that, but any media exposure to Robinhood is net beneficial for the company because at the end of the day, that leads to more people potentially trading on the brand. He says, imagine you could buy Snack. How many people would reach to pay 40 million people in finance? Yeah, that's a big deal, bro. That's a big, big deal. And I agree. Seeking Alpha's newsletters are not that good. Bloomberg's newsletters are not that good. The reason why Morning Brew took off is because Morning Brew actually is a newsletter that like speaks to the average person, right? And they make finance fun. And that's what I think Robinhood is getting right, which is why it could just be a lot more money for them. Okay, we should be getting an update on jobs report in the jobs report in just a little bit. 10 a.m. we should know. So let's see if we get any coverage on CNBC. If not, I'll just open up the website with the jobs report. And let's see if this moves the market at all in terms of expectations. S&P 500 right now, 426, recovering a little bit. Tesla's up 249. TFC is up. Snapchat is up. Meta is up. Palantir is down a little bit, 1550. SoFi 757 is up a little bit, and Nvidia is at 450 as well. So we're seeing a little bit of recovery going into the morning as we get into this jobs report. It should be starting in just a little bit. I'll play the audio now.
Awful the process is. These migrants see the United States as
Netflix at 389, hitting that 390 range. Robinhood at 970 as well. And Unity at 29.98. Unity has not been able to get through their issues.
Good Tuesday morning and welcome to another hour of Squawk on the Street. I'm Sarah Eisen with Mike Santoli today and David Faber, as always, live from Post 9 of the New York Stock Exchange. Carl is on assignment. Taking a look at stocks this hour, selling off again, down 0.5% on the S&P 500. NASDAQ down today, down 0.6. It's still positive on the week because it got a rally yesterday, but those gains are slipping. The only sector right now that's higher in the S&P, materials. Industrials and staples were up there too, but they just turned negative, and everybody else is down.
Okay, I have the report. Let me read it right here. I don't know if this report is good or bad. So let's see this, and then we'll get to CNBC for the coverage. The number of job openings increased to 9.6 million on the last business day of August. The U.S. Bureau of Labor Statistics reported over the month, the number of hires and total separations changed little at 5.9 and 5.7 million. So I think last time it was what, 9.8 was open? On the last business day of August, the number of job openings increased to 9.6 million and 5.8% respectively. Over the month, job openings increased in professional and business services. I don't know if this is good or bad. Gergevin posted it. Let me go to his as well. I don't know if what was the expectation? Maybe that's what I'm missing from this. Oh crap. I think this is bad. Oh, yeah, this is bad. Yeah. So we have 9.6 million jobs open. The estimate was 8.6 million. Oh, boy. That's not good. Yeah, S&P at 424. Oh, buddy. That's not good. Whoa, baby. That's not good. So that's what, as soon as I saw that number, I was like, wait a second. I was like, it wasn't supposed to be this high because last time it was 9.5. So 9.6 immediately made me think, wait a second, that's higher. Let's go to CNBC. Let's see what they're saying on it.
Consumer the thing that's upsetting investors.
They're not even talking about it yet. These guys they're not talking about it yet. Okay, so that's not good news for the markets. Oh boy, more jobs available. Firms have to offer more money. Yeah, I mean, look, more jobs means more money, means more people employed. And obviously that's good for the economy, but it's not good for inflation, which is not good for the economy. Yeah, so S&P at 424. It's not that dramatic of a decline. That's not good, man. That's not good. That's not a report you want to see. If we're looking for a Santa Claus rally, that's definitely a report we want to see a little bit better numbers on. All right. Why would that be bad news? Again, if there are more job openings, that means employers have to pay more money for talent. That means there's more talent with leveraging, with essentially leverage over the jobs, right? If you have 5 jobs and 10 people are competing for it, you will get paid less in terms of salary because you don't have the pricing power. You don't have the leverage. If there are 10 jobs and only 2 people are competing for those jobs, then they have the ability because, you need the employer, you need the employee. But as the employer, you have to pay more for those people because those people are going to command more of a premium because there's no one else going to be doing the job. Think of it as like McDonald's, right? Like if you don't have someone willing to take $8 an hour and they're demanding 20 and everyone's demanding 20 and you have to fill up that job, you're going to have to end up paying 20. So that cost is going to go to the consumer. That burger is not going to cost $5 anymore. It's just, in general, it's not going to be the best thing for the economy. Joseph says they should name it the soft crashing. Oh my goodness. Now, granted, I do think if we get to 420 on the S&P 500, I still believe what I've been saying since September, we will see money come in. We are not going to see money participate in money market funds if the S&P gets to that 200-day moving average and things really get bad. Like if it gets below 420, I think big money comes in. I don't think they stay on the sidelines to the end of the year. I really don't, especially if inflation is coming down. But this jobs report is not a good jobs report to have inflation continue to come down. It sounds harsh, but they want a higher unemployment number. Yeah, and the only way to get that is for those jobs openings to come down. Well, yeah, S&P down 0.75% now. We were just at 425. Now we are 7 cents away from seeing 423 on the S&P 500. That sucks. Sucks to end the market open like that, folks. But it is what it is. It's a bad report. Let's end it off with the word of the day. Maybe the word of the day ends up making it better. Oh, this is an interesting word of the day. I actually been hearing this the past couple of days. Word of the day is Nepo baby.
Nepo baby.
A celebrity with a parent who is also famous, especially one whose industry connections are perceived as essential to their success. They're saying Justin Trudeau in Canada is definitely a Nepo baby. His dad was like one of the most famous politicians. The media criticizes Nepo babies and their lack of perceived talent, but it's important to acknowledge that connections can only take it so far. So Nepo baby is essentially someone who got successful because of their parents' connections. But obviously, you still have to work for your success. But if your parents are, Barack Obama, it's easier to get into Harvard, like Barack Obama's kids did, than if your parents were not Barack Obama. So the stock market's kind of acting like a little Nepo baby today, acting all privileged, like it can just keep going down and people's money isn't relying on it. But it's, sadly, good news is still bad news. So this is bad. This is definitely not the best news today. Our entire system runs on Nepo babies. That's correct. Our entire system does run on Nepo babies. This is true. All right. So that's pretty much it. We'll see what happens. S&P 423. We officially got it. 423.99 on the S&P, teetering between 424. That's it. Stocks are red. We'll see what happens throughout the rest of the day. Hopefully tomorrow, we have the 10-year coming down a little bit and the market absorbs some of this news. Some of the big tech is not that phase. Like Google's fine, Amazon's fine, Meta's fine. It's some of these small cap regionals, banks, and indices that are falling a little bit harder. And that's pretty much what we're seeing today. All right, everybody. Thank you for joining. We will be back here tomorrow morning, 8:45 a.m. And we will keep it going from there. I'll see you guys on Finance Junkies today. And we'll see what happens. Bayer says, my kids will be Nepo babies after the news leaks in 2024 that I bought Palantir for $6. Hopefully that's going to happen for all of us. All right, everyone. Thank you all. I will see you tomorrow. Have a great Tuesday. Bye-bye.